It's 2 p.m. in New York, it's 7 p.m. in London, live from Bloomberg's world headquarters. This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Taylor Riggs.
And Wednesday whipsaw guys stocks swinging back and forth as investors just try to make sense of the headlines surrounding stimulus talks. The S&P 500 is pushing slightly higher. That's thanks to social media stocks post-snap earnings, but energy among the worst performers. And it's 48 more hours until a deal, apparently. White House Chief of Staff Mark Meadows says the administration is in talks with Speaker Pelosi to get together a stimulus package in the next 2 days. That's as the deadline for a pre-election package keeps getting pushed back. And looking beyond profits, Tesla reporting earnings after the bell and is all but certain to post its 5th straight quarter of profitability. But why that may not be enough to impress Wall Street, all that and so much more coming up. Romaine.
Yeah, and of course the markets are apparently waiting for that deal. We had a pretty tepid open here on the S&P 500 this morning, as well as the other indices. You did see a little bit of a bid come in here around the 10 o'clock hour, and then again, after a sell-off, you had some bids come in around lunchtime. This after Nancy Pelosi went on a competing network and talked about how she was happy with the progress being made. So investors seem to be putting a little bit of stock that the stimulus saga will potentially come to an end. A pretty interesting move today, guys, than what we saw in the Treasury space, seeing that 10-year yield a bump all the way up to 83 basis points. So that reflation trade still remains something that is in force at this moment across the world. Of course, we are still looking for what's going on with Tesla here in the U.S. and overseas. The offshore yuan and the onshore yuan rallying about 0.5%, Taylor. That's the biggest gain that we've seen there since July of 2018.
Yeah, big moves in the currency markets. Take a look at what the impact that's having on the volatility within the equity markets. Interestingly enough, the current spot VIX, November and December contracts, they're still below the 30 handle, but you're getting a little bit of an uptick recently. Of course, just as you're starting to get some jitters, but we're rolling over a little bit, of course, as we do the horse race that is the election. I do want to flip up the board, Romaine. You mentioned that reflation trade, and oh my goodness, take a look at the 10-year. We are at 80 basis points overnight. We touched 83 basis points. The long bond was up to a 165 overnight. The next level of support, of course, that we get on the 10-year, if it drifts higher, at 90 basis points, and then the highs of 95.5 that we got back in June, Caroline. But 80 basis points for now catches my attention.
It really does. Keep an eye on those yields. Keep an eye as we get news from the Fed Beige Book, sort of anecdotal evidence coming from the regions of the U.S. as to how the economy is doing. And currently, the Fed is saying that economic activity can continue to increase across the districts. The release of this current economic condition showing that the pace of growth characterizes slight to modest. Banks saw increased loan demand driven by mortgage demand in particular. We know that real estate market is on fire. So we continue to focus in on how the economy is doing, particularly without any stimulus yet solidified. Let's get some more intake for you. Joanne Feeney, partner and portfolio manager at Advisors Capital Management, where she holds about $3.7 billion in assets under management. Joanne, it's great to have you with us. You needing to see a stimulus deal to support where you currently have your assets?
No, not at all. You can't count on a stimulus. It'd be nice if it came along, but you really have to invest around that. And there are ways to do that. You know, there are still some really good secular growth opportunities out there, whether or not we get a stimulus. But the smart cyclical opportunities, those would certainly be helped by a stimulus. But if we don't get one right now, we're very likely to get one, in the February time space. So, you don't need it right now. Be nice, but you don't need it. In the meantime, though, one has to be careful about being too exposed to consumer spending, because if that stimulus doesn't come along, you have to worry that households have to pull back a little bit. And then there are places you can go in the market to protect yourself from that. So by combining some secular growth names with some cyclical names and some defensive names, you can create a balanced approach to investing. And we're doing it with individual stocks, so we really can pick our places, and that seems to make clients a bit more comfortable with staying in the market.
So, Joanne, obviously the consumer spending space still a little bit precarious here. A lot of investors had moved into tech stocks that were much more heavily exposed to business spending. The idea that all of this spending on software and other services to bolster up these digital networks and cloud networks, that this could potentially be a safe space to be. What do you make of that?
Oh, yeah. I think that the acceleration of the move to online, the move to remote working, the move to sort of online entertainment, all of that will continue. And so there are still places to invest in that space. Now, one might want to avoid some of the more high-flying stocks, the better-known names like Amazon, because you have to stop and worry a little bit about those valuations. particularly if you start to anticipate that if the Democrats win and unify the government under their rule, that you could end up with higher capital gains taxes, which would likely trigger some sell-off to, move those capital gains into a lower tax year, right, if you anticipate that happening in the future. But there are ways to go into, for example, other positions that are still benefiting from the online move. A company like Broadcom, for example, is one place to go. It's still reasonably priced at, I think it's 15 times next year's earnings. Plus, it offers about a dividend yield of about 3.5%. So our clients are looking for that combination, potential appreciation plus some income. The biggest fear people have, right, is outliving their money. And so to generate some income while you're positioning them for some appreciation, it helps them sleep at night.
Interesting that you manage both the growth and the balanced strategies. And I am curious, where do you find balance in this market, particularly in the last few months, as some of the equal weight has now outperformed the market cap weight?
Yeah, right. It's a mixed bag. Some people, they look at that headline number and all they see is the market's gone up and up and up, and is it worth getting in at this point? And you're exactly right to point out that not everything in the market has gone up. And we could see another rotation into those names that have not yet recovered. So one place to look for growth is smaller companies that are less well known. We've bought recently a position in a company called Stone. Stone is a digital payments technology provider out of Brazil. Now, Brazil might be a mess, right? COVID is still a problem all over the world, but particularly in South America. But the ongoing shift to digital payments instead of cash is at an early stage in Brazil. So it's kind of like getting, PayPal 10 years ago. So that's one area for growth. We like fintech in general. Another name we added recently is nCino. And that's a company that's doing back office software for banks. So even though banks are continuing to struggle because they're really leveraged to economic recovery, they're leveraged to the yield curve, right? And so they're going to take a little bit longer to recover. But if you get into a fintech like nCino, with that move to create more efficiencies in the back office of banks, you can position for appreciation even while you wait for economic recovery to pull the other banks along, which, by the way, we like in the balance strategy because they provide nice income and they have that tailwind of economic recovery, which we think will enable the banks to outperform over the next couple of years. And if you look at long-term growth, which a lot of our clients are interested in, that is the way I think to position, particularly in a balanced strategy. Our senior economic advisor, Alan Greenspan, contributed our commentary this week, and he goes into the value of that long-term investing, and we're really trying to hew to that for our clients.
Joanne, we just had your senior advisor there, Alan Greenspan, on the network a little earlier ago. Great to have you on as well. Some interesting picks there. nCino, Stone Co. Joanne Feeney, partner and portfolio manager at Advisors Capital Management. That ends that segment. But coming up next, we're going to talk about, that stimulus deal. Both parties continue to remain optimistic of a deal, but Mitch McConnell warns the White House, don't be in a rush. Plus, looking to impress, Tesla looks to report a profit for the fifth consecutive quarter, but it's going to take a lot to win over some of the company's critics and renters. Get ready to negotiate. The world's richest cities, they've got some great deals if you're looking to rent an apartment. All that and more coming up next. This is Bloomberg. All right, time now for our top calls and look at some of the movers on the back of analyst recommendations. First up, let's take a look at Snap, getting praise across Wall Street after those third quarter results surpassed pretty much everyone's expectations. Jefferies boosting its price target to 41 from 33. The analysts saying investors, they're going to struggle to find negatives this quarter and sees numerous drivers for the quarters ahead. Shares here right now up a whopping 31%, record high. Next up, Pinterest upgraded to buy from neutral. This over at BOFA with a $58 price target. The analysts citing those strong results from social media peer Snap, which provided another sign of strong online advertising. Shares here also at a record high, up 9.5%. And finally, let's take a look at Peloton. Price target being raised to a street high 160 from 120 over at KeyBank. The analysts expecting more gym closures, more gym bankruptcies to improve the long-term outlook for Peloton. Nevertheless, Peloton getting caught up in some of the sell-off and some of those stay-at-home trades down 4.5%. And those are some of your top calls.
Well, and Romaine, besides some of the equity markets we're following, it's all about stimulus, right? And that re-inflationary trade. Take a look at this. One reason, perhaps, why some analysts at JP Morgan saying that don't count on a Democratic win being 100% higher for yields? Well, because of this, the budget deficit. Take a look at this. And then, of course, that means that the Fed may also start to cap rates on the long end as well to help fund this budget deficit. We do know that talks certainly continue. Where the market's still hoping for a when, not an if scenario. And for more on the stimulus, let's bring in Michael Zezas, Morgan Stanley head of U.S. Public Policy and Municipal Credit Strategy. Michael, I am curious on your thoughts. Instead of just doing and agreeing on a bill of, I don't know, let's say $500 billion or so, we're choosing to do nothing at all. Are you confused perhaps of what's going on in Washington?
Well, it certainly seems to follow a type of logic that investors aren't accustomed to, which is more political logic than economic logic. But I mean, I think what you're supposed to keep your eye on here is that the paths in the short term to stimulus are pretty uncertain, as is pretty obvious by the news flow today. Maybe they can get to a deal before the election. Maybe it's going to come after. But your medium-term paths mostly point to an economic stimulus deal happening. Most post-election outcome configurations, in our view, get you some level of stimulus. So if that is ultimately what matters at the end of the day, is that you get it sometime in the next couple of months, then I think what you're seeing in terms of the price action in the bond market today is sort of appropriately reflective of what is likely to happen, i.e. we're likely to get some meaningful deficit expansion. It's likely to underwrite continued economic recovery, and you should be seeing yields move higher and a bear steepener of the yield curve ongoing.
Michael, what else are bonds, our treasuries pricing in at the moment when it comes to the election? Are they pricing in a so-called blue wave? Are they expecting the presidency and Congress to go towards the Democrats or not, as the case may be?
I mean, I don't know that you can intuit something that specific from it as one configuration or the other, but I think it's fair to say that most election outcomes give you a deficit expansion, including a COVID relief package. The one that we think might be the most challenging, where the sort of the political hurdle is the highest to clear, is one where the Democrats take the White House, but the Republicans keep control of the Senate. That probably means that markets or economic data have to demonstrate a bit more challenge before you could get both sides coming together. But your other likely scenarios probably get you COVID relief at the end of the day. And in particular, I think a scenario where either the Republicans win the White House and both chambers of Congress, or the Democrats win the White House and both chambers of Congress, those are both configurations that probably deliver you deficit expansion beyond COVID stimulus, as both parties legislate what's within their power to do. For Republicans, it would be tax cuts. For Democrats, we think it would be spending increases in excess of the tax hikes they might be able to achieve.
Yeah, I am curious more about that. I mean, the breakdown now obviously was a 53-45-2 in favor of the Republicans. Even if the Senate were to sort of flip into Democrat control, there is a sense here that fiscal spending and some sort of fiscal expansion is still going to happen, whether it's under a Republican-controlled Senate or a democratically controlled Senate and White House. Do you buy into that?
Yeah, no, I think the Senate's an important binary variable here. So if the Democrats take the White House, but the Republicans keep control of the Senate, I wouldn't count on there being an easy path to fiscal expansion. You're obviously seeing at the moment in Washington, D.C., one of the main challenges to getting this COVID relief package done is that Senate Republicans are expressing fatigue with continuing to increase deficits. Now, if they have control, but they don't have the Senate, but they don't have control of the White House, then it is less costly politically for them to prioritize deficit concerns. And that could end up being a pretty tough negotiation. And, like many of these deficit expansion, fiscal stimulus negotiations have gone in the past, you could see both sides come together pretty quickly when economic data or market data shows that that's necessary. But that's not of a lot of comfort to investors if you have to see market weakness demonstrated first before you get a deal that's appropriately supportive.
Fascinating. I have a big suspicion that you're a very busy man at the moment. So we thank you, Michael, at the moment for giving us some of your time. Michael Zezas, of course, Morgan Stanley, head of U.S. Public Policy and Municipal Credit Strategy. Great to have some time. Now, coming up, the value of intangible, heavy companies like Google, like Facebook. Well, of course, they've been rising, soaring today amid the pandemic. What impact does it have on the economy and the labor market? We'll break it down next. This is Bloomberg.
This is the program where we can really bring you some of the wonky stuff when it comes to balance sheets and market caps. Take a look at this. When we talk about the composition of market cap, intangible assets versus tangible assets. More importantly, look at how that has changed over time. Sarah Ponczak brought me this chart. I stole it from her. Market value of a company now makes up 90% of intangibles. 1995, intangibles were just 68% of market value. For more, let's bring in Bloomberg, Sarah Ponczak, who wrote this story. Sarah, I'm curious about the why behind that change, and more importantly, how COVID also has affected that change.
Right, so we really have seen this swift change, and it started a couple of decades ago. It's sped up after the financial crisis as companies really started to emphasize being asset light, and now with the COVID economy, it's accelerating once again. So as Carlyle estimates, they think that we could see a rise of more than 10% in intangible asset investments. And the reason that this is so important is it has major implications for the economy. You think about how the economy has changed over the years to more so a digital economy, a knowledge-based economy. All of a sudden, ideas, data, algorithms, these are really what matter most to companies and are valued so highly. But at the same time, these types of assets, invisible assets, intangible assets, they're hard to value, and you don't need many people to keep them running.
Yeah, that's interesting. I guess some people would call that fraud, but I guess in the day and age we live in right now, that's a buying opportunity. Are there concerns here that the inability to either properly identify or properly value those assets opens up some of these stocks and I guess the investors to some trouble down the road should the actual growth not materialize?
Right. Many times when investors hear intangible investments fetch a much higher valuation, you think about the dot-com days when people are looking at site visits, at eyeballs. But I'm wary about saying this time is different, but there is proof that when you look at the likes of Facebook, for example, and the data that they have on their users, that these are actual assets that do create profits, and not just millions in profits, but billions of dollars worth of profits. But the worry is that they work until they don't. At what point do you become saturated? So yes, there is a bit of a worry there, but at the same time, in the new day and age, you can't just write off intangible assets. You really do have to bring them into your valuation structure and methodology.
You do. How do you bring that thought base into what it looks like for the economy, what it means for people working or lack thereof in the future?
Right, it's a very significant question. If you look at recoveries from recessions that have been very intangible investment heavy, you've seen slower labor market recoveries. So now the worry is that we still have an unemployment rate just below 8%, that as we emerge from this COVID economy, if companies invest more and more in intangible assets, then we could be seeing a slower labor market recovery and just more economic inequality and wage inequality too.
Yeah, this is a fascinating topic, and you've done a lot of great reporting on this, Sarah, and I wish we had more time. Definitely want to have you back to talk about it, particularly from that inequality perspective, because if you have intangibles sort of running these businesses, you have fewer people, I guess, to buy the finished product. Sarah Ponczak there, our Bloomberg cross-asset reporter. Taylor, pick it up here with the Business Flash headlines.
Thank you, Romaine. Is this an intangible asset? Bitcoin rising to the highest level since July of 2019. This is after PayPal announced it would let customers use cryptocurrencies. Galaxy Investment Partners CEO Mike Novogratz called it the biggest news of the year in crypto. He says banks will embark on a race to service digital currencies. General Motors has unveiled its much-anticipated battery-powered Hummer. The truck, based on a military vehicle, will have a starting price of $80,000 and a range of 350 miles. Production will start in the fall of 2021. We spoke to GM President Mark Royce.
We'll see as we announce the different markets, but just keep in mind it is designed and engineered and made to be a global vehicle.
And NASDAQ has warned that New Jersey's proposal to tax financial transactions will drive investors out of the stock market. The exchange's CEO, Adina Friedman, told Bloomberg TV she believes that eventually the state government will see it is not a good idea. New Jersey is considering a tax of 1/100th per trade to help plug a budget gap. All about those budget gaps and those budget deficits, Romaine.
It is, Taylor. There's another story going on out there. And you know what it's about? Apartment rents.
Real estate. Let's talk
Real estate. What's going on with real estate, Caroline?
Well, funnily enough, it's getting cheaper, apparently, in New York City and San Francisco. Some of the rents are going down. Not so lucky if you're in the suburbs. One story that really took my attention was the fact that we've all been talking about New York flight, people leaving the metro area.
Right.
According to actually Orbital, which is looking at mobile data, it says actually there are more people in the New York metro area at the moment than there were prior to COVID. I have a feeling maybe they're all in like upstate New York or something.
Pompano Beach. That's interesting. I guess that's just like a tax dodge or something. Philadelphia, Camden, Wilmington. That's an interesting move there too. And I guess you're seeing here in New York area a lot of people moving out to Westchester and San Francisco, your old stomping grounds.
They all went south. They went to LA and San Diego to get that good summer tan.
Yeah, all right.
It's all about the tan, clearly. Let's have a look at the markets. We're currently higher on the NASDAQ. This is Bloomberg.
This is Bloomberg Markets to Close. I'm Romaine Bostick.
I'm Caroline Hyde.
And I'm Taylor Riggs.
A little bit after 2:30 here, getting settlement of NYMEX crude futures in New York, settling right slightly above $40 a barrel on this day, but a pretty down day here in the space. Keep in mind with that latest EIA report showing the massive build over in that Cushing, Oklahoma storage, back above $60 million a barrel. First time we've seen that since May. Also saw domestic gasoline inventories swelling by about 1.9 million barrels. Demand measures also falling. So you're seeing both gasoline and crude oil drop by about 4% here on the day. And just real quickly, two important milestones going on in two other areas. Natural gas topping $3 per BTU in the U.S. for the first time in years, and copper over $7,000 a metric ton in London. And you're seeing there on your screen $3.21 a pound here in New York.
And Romaine, if we want to talk about a stock that has been the story of the year, pretty much everyone on Robinhood has been looking at it. It's Tesla. We're going to get a very important update in their quarterly earnings that we'll get after the bell. The focus for me, it is the blue bar, of course, on the right-hand side of the screen. Revenue growth coming from China. Where does China shape up in terms of revenue growth for Tesla? Wedbush, for example, Romaine looking at 40% of global sales coming from China by 2022. China clearly the leader, and then the U.S. follows. So the role of China, that Shanghai factory, potentially a game changer.
All right, joining us now to talk a little bit more about this, Oppenheimer senior analyst Colin Rusch, who has an outperform rating on Tesla. Joining us now. Colin, a lot of folks looking to earnings tonight. We know that for this company, the EPS numbers don't matter quite as much to investors as some of the other metrics. What are you keeping your eye on?
You know, the number that we really focus on is on the automotive gross margin, ex credits. And so what we want to look at is the manufacturing margin that they have. It's a good indicator of the efficiency of these factories relative to the strength of the ASPs. And certainly as we look at over a multi-year period of time, the operating leverage on this model is potentially very significant. And so the trajectory and the gross margin is the key metric for us. The other number that we're going to look for is the delivery expectations for the fourth quarter. You know, the company's talked about getting to close to 500,000. As long as they're getting close to that number, I think the investor base will be fine. But really, the gross margin is ultimately the number we're really concerned about tonight.
I mean, it's a big ask, isn't it? 181,000 cars they've basically got to pull out the bag and deliver in the fourth quarter to meet that sort of a number. Talk to us also about what you're hoping to glean in terms of China and where they stand in terms of production out there and in terms of demand.
Yeah, I think you make a good point that there is a lot of sequential growth to hit that number. You know, but one of the things that this company has done is really ramp up capacity in China, you know, at a much faster rate than anyone had ever expected them to. And so their ability to continue to push forward with that and then also get incremental throughput on their Fremont facility, I think is a very real possibility and certainly something that I think a lot of folks are anticipating. You know, as we go forward and think about valuation on this company, and I think a lot of folks are looking out to 2024, 2025 on this, it's really about their ability to, replicate what they did in China in terms of building these factories very quickly and then ramping them at accelerated timeframes. And, you know, one of the things we are going to look for tonight is commentary around the Berlin factory as well as the Texas factory and how quickly they're going to be moving those projects forward and can expect to see product coming out of them.
With the focus on margins, Colin, how do you look at the recent price cuts that we've seen? on some of the cars, and as well as the expiration of the subsidies and some of the tax credits that have gone away?
Yeah, so, as we think about this company and their ability to actually drive margin and earnings potential, part of it's being driven by volumes. And so as they are expanding their capacity, they're able to drive efficiencies through some of these manufacturing the manufacturing facilities. And so we're looking at those cost reductions being more an indicator of what they're getting out of the cost structure versus what they're seeing on the demand side. We haven't seen a shortage of demand for any of these products at any point yet. Certainly Model S and Model X availability has come down a little bit, and we've seen some of that early boost come off, but the core demand is still very much intact. And so that's what I think is happening here, is that we're seeing those cost declines get passed on to customers. And as we see that come forward, we do think they open up incremental markets for the products.
And Colin, with regards to, I guess, the push into sort of the, I don't know if you call them ancillary businesses, obviously the expansion of the battery production, but also some of the other sort of power generation things that Musk has sort of attached to Tesla, for better, for worse. Do you see that being sort of a net positive to the company down the road?
Yeah, so we really, figured out early in our coverage on this that the battery technology and the battery management system was core and very unique in terms of their engineering. And part of it is really the materials that they're using within the batteries. And so we think they have a very substantial lead on the order of 3 or 4 years on the rest of the industry in terms of that battery material design and how that is packaged up into their battery management system and the rest of the package. So as we think about, kind of what their entrance into other areas, I do think the continued execution on driving cost out of that battery is important. We haven't seen them be, I think, real serious players in the stationary power market yet, or really take that solar business as seriously as Musk is alluding to. They bought SolarCity a number of years ago. It's about 20% of the size of what it was when they bought it in terms of megawatts installed. They've changed the channel strategy. They've been slow on delivering new products, and so they certainly have the potential to address those markets and an advantage cost structure to do so. But we haven't seen them really put the resources into driving those markets, and so we continue to focus on the automotive business on our valuation.
Colin Rusch, great to have you with us, Oppenheimer senior analyst with, of course, an outperform rating on Tesla. Now, coming up, we hear from Delta Chief Executive Ed Bastian as part of our CEO Spotlight, talking how to support people in this moment. This is Bloomberg. In this week's CEO Spotlight, well, I've been speaking with Delta Chief Executive Ed Bastian about what the future may hold for air travel amid the coronavirus pandemic. Now, he discussed how to support his people at this time, how to support morale amid the company's voluntary reduction, and indeed employees taking unpaid time off or even retiring early. Take a listen.
We've had over half of our staff take unpaid leaves of absence at various times throughout the summer. Saved us an enormous amount of money. We've had 20% of our workforce early retire this summer, which was hard to go through, but it was necessary because those people stepped aside so that younger people could hold their jobs. We've had voluntary reductions of work hours. All of it's been completely voluntary to this point, and as a result, they have saved jobs. They've saved Delta a tremendous amount of cash. We're getting our cash burned down to really manageable levels by the end of the year, and we're going to be well positioned because the morale is really it's interesting. It's really strong. When I travel all the time, I'll be traveling tonight actually, and every place I go, not just customers but fellow employees thank me on behalf of the entire company for what we're doing to protect them. They feel that sense of protection. I speak to them weekly. We have town halls. We have a lot of communication vehicles using video technology as a tool in a good way. And people feel very connected, distant, but very connected to our mission. And it's really good to see.
Does it make you look inwardly at yourself? as CEO and the pay that you're getting and the way in which you're recompensed and looking further out, how does it make you feel? How do you reassess the role that you play?
Well, that's one of my roles here at the company. I'd like to say the role of a CEO is to be looking out on the horizon, 3 years, 5 years, 10 years out, where the company is going. And it's probably uniquely the role of a CEO. And that view has changed a lot over the course of this year. What it's done for me is it's reminded me, one more time, how important service is in this business. When we see what our customers are telling us, what our people are telling us, how protecting their wellness in every aspect of that word was our top priority. We're doing that. We've been protecting our cash and our resources throughout, and we've raised plenty of cash to get through a long winter. But also, Caroline, you have to protect the future, and we got to keep that long-term goal. And we're playing the long game. It would be very easy for us to be selling the middle seats. The competition is doing it broadly. We're one of the few airlines in the world that isn't selling the middle seat. I think people would understand, given our financial predicament, that we needed to raise the cash. But we want to put people and their safety and their wellness above the money we'd raise, the profits we'd raise by selling those middle seats, because we know in time we'll start to sell the middle seats and people will come back when they feel safe and when the medical authorities tell us air travel is the way people should travel long distance. And as a result of that, the brand is going to maintain and be built at an even higher level because of how we handled ourselves during this pandemic.
Look out for me 3 years from now, and about the talent pool. You've got a lot of people working for you at the moment, some that are having to go unpaid, some that are maybe even forced in the pilot arena to take furlough at some point or have to lose their roles. What do you think of enticing good, strong expertise into this business when we can see that this crisis is going to have long-term implications?
Well, we've been very much focused on retaining the talent that we have within the company. While our numbers are reduced and we're now a 20% smaller company because we've done that all through voluntary measures, we've made certain the talent that we've brought to the company, who we consider to be the very best talent this industry has, is still here, is working, and has that long-term goal in mind. And it's interesting. We talk about what our roles are over the next several years and how we inspire, and in a really hard time. My boss, the chairman of Delta, Frank Blake, told me at the start of the pandemic that people think that crises build character. And we've been through a lot of crises. And I think we all know that crises don't build character. Crises reveal character. It reveals your values. It reveals your purpose. This has been a time for all of us, not just in the travel industry, but every walk of life, to have the moment of reflection. Because of the pandemic, we've all been quieted and we've all seen all the challenges society is going through, probably a little more clearly than ever before.
Delta CEO Ed Bastian there, part of our CEO Spotlight. Now, let's get over to Taylor. It's this week's Media Moment.
Thank you, Caroline. And of course, we just heard airlines anxiously awaiting federal aid, but so are state and local governments. As we've been reporting, the White House looking for a next fiscal stimulus deal in the next 48 hours. House Speaker Nancy Pelosi saying that she is, quote, pretty happy about the negotiations. Here to discuss the impact on his city, it's Mayor Robert Garcia of Long Beach, California. Mayor, I'm a California girl, so it's great to have you on the program. Talk to me about fiscal stimulus. What specifics would you like to see from Washington?
Well, we've been very excited since the HEROES Act was first introduced. Obviously, the need for cities and states for direct funding is really important. We're cautiously optimistic that this latest round of negotiations, that we are closer to that $2 trillion mark. What it means for cities, first and foremost, is the ability to continue mass testing, to ensure that local clinics are supported with PPE, our local hospitals have funding. There's resources there for our public schools so they can reopen safely, and direct support for cities for issues around cleanliness, around safety, around emergency response. And so I really hope that Senate Republicans understand that in order for cities and states to survive, this stimulus is incredibly important. So we want to encourage those talks to continue, and we're heartened that there seems to be some support here.
On that note, it's been interesting. The Federal Reserve tried to do their job in the Federal Municipal Liquidity Facility Program, Only 2 or 3 issuers have actually tapped that program. Is it too cumbersome? Do you need the Federal Reserve to play a bigger role in this as well and making it easier for you to borrow at attractive rates?
Well, listen, I think that that process is important, but what's much more important directly is direct support so that we can and put resources into the cities, that we can get money out to a lot of the community organizations as well. And so the need right now is around stimulus. It's around residents needing direct resources so that they can have an additional stimulus check. It's around ensuring that all of these testing centers that are all up and down our states and our cities can continue going. And so, while the borrowing is important and a key piece of it, it's not nearly as important as the direct support for residents and the direct support for cities. And remember, there's money in here for hospitals and for schools. And so we need that deal and the bigger checks on their way.
How about small businesses? Many have said that they don't need more PPP loans, they need grants. What are small businesses telling you?
That's exactly right. That's exactly what we're hearing. They really need direct grants. So through the first recovery dollars that came through the first time, our city and cities across the country were able to put money directly into small businesses, directly into programs that were helping small businesses, and that's what they need again. When you have some of these places that have been shut down, whether they're restaurants or bars or retailers, they really need that additional support. We're seeing unemployment and workers being impacted in a new way. We're seeing some businesses close that will never reopen in this economy. And so I just don't understand why the Republicans and on the House side and the president can't just get together and cut a deal. And the deal needs to happen now before the election. People are suffering, and small business owners, many are literally have on themselves borrowed so much money and need that additional support to survive. We're hearing it every single day.
Some of the unintended consequences of this, of shutting down schools, for example, many kids, their only hot meal comes from the school day. How are you addressing inequality that is rising from this pandemic? How are you thinking about reopening schools when it's safe, masks, etc.?
Reopening safely is the most important thing. The truth about the economy is we're never going to have a functioning economy until schools are open. Parents need to have the ability to work freely. Kids need to be back in classrooms, but we have to do it in a way that's safe. The issues around, for example, school lunches are being addressed by most school districts. We are still providing in our school system here the lunches to kids and to families that need them. The bigger issue comes around when kids get back into the classroom. And so out here in California, there's very limited classroom instruction happening in the state. And we have a variety of challenges, one of which is getting schools ready. You have many classrooms that have very poor ventilation. You have many schools, particularly in low-income neighborhoods, that need PPE and additional support. And you have many teachers that are also, rightly so, are really scared about being in the classroom and either passing on something to kids or to other families or getting something themselves. And so there is still a lot of work to do. We're fortunate in California that I think our governor is really leading the way around school safety. We are not reopening I believe, quicker than we should be. We're not seeing what's happening across the country in California. And so we have a good plan. And right now it's really about the little kids. It's that pre-K, first grade, second grade we're focused on, and then we'll go from there.
Well, you said it, you're busy, so we will let you get back to it. That is Mayor Robert Garcia of Long Beach, California. Thank you as always for your time. And we will have much more ahead. From New York, this is Bloomberg.
It is time now for our stock of the hour. We've got to talk PayPal. It's added immediate legitimacy in some ways to crypto after announcing it will let its customers transact and trade in the new age money. For more, let's bring in Bloomberg's Dave Wilson. That's quite a big thing to say, that it suddenly served as some reinforcement. Crypto's had its fans prior to this, but nevertheless, it does feel as though people are getting excited about this deal, that you can buy things with crypto. The question is, anyone who will use it to buy anything?
Yeah, that's been one of the issues for some time, the whole idea that, cryptocurrency has really been sort of a speculative vehicle rather than a way to pay for stuff. And the issue of mainstream acceptance has been out there, no question. It came up earlier this month when Square, the payment processor, decided to invest $50 million in Bitcoin. And now you have PayPal, one of Square's competitors, coming along and actually offering the customer the ability to buy, hold, and sell Bitcoin, Ethereum, Litecoin, Bitcoin Cash. I mean, it's going to be available in the U.S. in the coming weeks. They're looking to expand it internationally next year and also to add it to their payment app Venmo. They have clearance from the state of New York, what's called a conditional bit license. And there are going to be some restrictions on people's ability to trade. I mean, you have to buy the coins on PayPal. You can't transfer them in and out of accounts. Nonetheless, it is a step toward greater acceptance of a more speculative kind of currency. At least it's kind of served that way over time.
All right, Dave Wilson there with our stock of the hour. PayPal shares up 6%, Bitcoin up 7%. We'll be back in a moment. This is Bloomberg.
3 p.m. in New York, 8 p.m. in London. I'm Caroline Hyde.
I'm Romaine Bostick.
I'm Taylor Riggs, and this is Bloomberg Markets, The Close.
And Wednesday, we get whipsawed. Stocks swing back and forth as investors try to make sense of the headlines surrounding stimulus talks. The S&P 500 now pushing slightly higher. It's thanks to social media stocks post-snap earnings, but energy among the worst performers still. Meanwhile, it's 48 more hours until a deal, apparently. White House Chief of Staff Mark Meadows says the administration is in talks with Speaker Pelosi to get together a stimulus package in the next 2 days. That's as the deadline for a pre-election package just keeps on getting pushed back. But looking beyond profits, Tesla reporting earnings after the bell and is all but certain to post its 5th straight quarter of profitability. But why that may not be enough to impress Wall Street. All that and so much more coming up. Romaine?
Yeah, we're going to talk about sort of this, Duncan yo-yo of a stimulus deal and whether it will be or won't be. NASDAQ 100 is higher on the day after being lower on the day. Obviously, a lot of the strength coming from some of those digital ad platforms. Snap is not in that index, but Facebook, Alphabet are rallying pretty hard here. Facebook up 5% on the day. There is a drag on the opposite end of that, though, with Netflix and Amazon down pretty significantly. Netflix down 6% on the day. Texas Instruments also down. Both Netflix and Texas Instruments reporting some disappointing earnings last night. The Russell 2000 has been struggling between gains and losses as well. On one side, you have some names in the consumer staple space like WD-40 rallying 17%, having its best day on record. But then you have a lot of discretionary and healthcare names to the downside. Two of the most notable decliners today, Sunrun just really plunging down about 20% over the past 8 sessions, down 9% on the day, and iRobot down significantly, about 17% off of the back of some bad earnings. We just talked about that bump that we've been seeing in Bitcoin, of course, on the back of that news with PayPal. And Taylor, keep an eye on Tesla earnings after the bell.
Oh, yes, that is something definitely, of course, that we always look forward to. I also look forward to negative yielding debt. Can you believe that? This is a great way to lose money if that's what you're interested in doing. The pile of negative yielding debt, now 25% of total investment grade debt outstanding. It's worth more than $15 trillion. This is near the record that we had this time last year. So I'm increasingly watching that slope, I should say, which is the line migrating upward, if you will. I do want to flip up the board and talk about sort of the broadening rally that we continue to see. In the last 2 months, you've seen equal weights now outperform on the S&P 500. Some of the market cap companies, Ned Davis Research, Luthold Group, even strategists at Morgan Stanley, seeing that they're increasingly looking to some of these smaller cap stocks, and this equal weight index is the way to track that, as some outperformance, of course, as we look for that economic cyclical recovery. Romaine?
Yeah, and the sustainability of that recovery, Taylor, of course, could hinge on the next round of fiscal stimulus, whether we get it or whether we don't get it. Interesting to see. Let's bring in Anna Han. She's an equity strategist over at Wells Fargo Securities and get her thoughts on where we stand right now in the markets. And we're going to start off, Anna, here with that fiscal stimulus deal and whether you think the market's expectations for getting that done are warranted.
Well, it's certainly warranted because it's made headlines, and it's been several months in the talks. We had a great package a couple months ago. It really helped spur this economic recovery. But frankly, our view is that we don't see stimulus package passed before elections. And even without it, though, that doesn't mean the economic recovery is doomed. In fact, we still think the recovery will proceed. And in 3 to 6 months, you're going to see that sequentially improving narrative. And that's going to help earnings growth going forward.
So is now the time to finally rotate to get into the cyclical stocks, or is it still too early, Anna?
Well, cyclicals have actually been performing for quite some time, but it's how you measure that cyclicality and how you measure that value. When you think cyclical stocks, you have to think what's most economically sensitive. But don't forget, it's not just economically sensitive. What's most, we call it COVID beta, COVID sensitive. So as COVID vaccine timelines improve, and we saw a little bit of a hiccup last week, but longer term, the consensus is you believe vaccine will come around and that economic growth will come back, reopening will continue. And with that, those economically sensitive names have seen a little more life breathed into them.
We've talked so much on this program about how a blue wave is inflationary and equities could get a boost off that. You write that you disagree. Why?
Well, with the blue wave, to us, if you're going to do a tax and spend program, which is generally what the blue wave comes with, well, who's going to stick around and pay for that bill when it comes around? Raising taxes can weigh heavily on corporates. And for companies who saw a boost a couple years ago when taxes were cut, well, you have to believe that if taxes were raised, you would see that headwind to equities. So for us, we're a little more hesitant that a full blue wave would be this panacea or this great boost for equities. And in fact, we are keeping a very close eye, mostly on the Senate race, to see which way it flips this year.
And I want to get your thoughts here on the earnings season in full swing. About 40 companies today of significance, about 40 of significance tomorrow. Of course, Intel, Coca-Cola, Dow, a few of the names you expect tomorrow. Of course, tonight, Tesla. What do you make of the earnings season so far? And do you think that's going to be enough maybe to provide the market with a little bit more to rally off of?
You know, that's a great point you bring up, Romaine. With earnings season, what's been interesting is, on average, the post-earnings reaction has been negative to all the S&P 500 names that have reported. And what does that tell us? It's this phenomenon we label sell the news. That is, once investors see that the earnings come out, it's not really matching their expectations. Even if it's a beat versus the EPS estimate, if it's not really matching their long-term investment goals, well, investors will sell it, and you'll see that short-term knee-jerk reaction. That's what we're seeing so far, and that might tell us and be a hint that maybe valuations really have gotten ahead, or expectations are a little harder to impress this quarter than it was last.
So where to put money right now, Anna?
Well, we talked about the cyclicals, and for us, we think that, okay, day to day, you're getting whipped around by COVID situation, by the elections, and by stimulus talks. But where do you think we're going to be in 3 to 6 months? We believe that economic recovery will come about. So for us, we like the cyclicals. We like those more economically sensitive materials, industrials, energy groups. Now, there's certainly a higher risk, and that's not to say that the growth or the traditional tech groups you've been seeing won't work. But on a relative basis, we do think that these cyclical industries will have better outperformance in the midterm.
On a similar note, is that bullish for Europe over U.S., for example?
Well, when you look at Europe, especially in the UK, you've seen some talks about maybe slowing down that reopening, peeling back some of it, because you're seeing another rise in cases. And you're seeing that a bit here in the US too, but the concern has been over Europe that is this recovery, is their GDP growth really going to be rebounding as fast as it had started? For us, we still think that the better risk reward is in the US, but that's certainly a place to look.
We thank you, Anna Han, as always. Beautiful backdrop. Wonder where she got it from. Equity strategist at Wells Fargo Securities. Thanks for the time. Now coming up, weighing the whole future. After being the CEO of Whole Foods for 30 years, we hear from CEO John McKay on when he plans to leave the company. Plus Datto debut, we speak to the company's CEO on why going public was the best move for the software company. And working with Google after the DOJ's landmark case against the tech giant, how will it affect the relationship with, for example, Verizon in the long term? All that and so much more coming up. This is Bloomberg.
This is Bloomberg Markets to Close. Time for a quick check on some of the latest business flash headlines. Starting here, Apollo Global Management's board, they're investigating co-founder Leon Black's ties to disgraced financier Jeffrey Epstein. Black asked for the investigation after more information emerged about their business dealings. Last year, Epstein was found dead in a Manhattan jail cell where he was awaiting sex trafficking charges. Authorities ruled it a suicide. There was a double-digit surge in applications to the top U.S. business schools this year. The top 20 MBA programs saw a 13% spike. According to Bloomberg Business Week, that reverses a 5-year downturn. The reasons? People facing a pandemic-stricken job market sought to boost their prospects. Plus, admissions departments opened their doors just a little bit wider. And John Mackey, who's been the CEO of Whole Foods Market for over 40 years, well, 3 years ago, he sold his company to Amazon for $13.4 billion and agreed to stay on. Now the question is, when will he leave? Mackey spoke to us for the latest episode of The David Rubenstein Show.
I will leave Whole Foods sometime in the next few years. I haven't announced a retirement date yet. And COVID it's a crisis, so I'm dealing with the crisis here for that. And I always make this joke that it's like Whole Foods is my daughter, and I literally married my daughter off to the richest man in the world. And I just kind of came along to make sure the marriage settled in well. And I'm still here, but I know that the time will come eventually for me to leave. It's just not yet, and I'm not quite sure when it will be.
And that's your Business Flash update, Caroline.
What a great way of talking about it. Thank you, Taylor. Time now for Options Insight with Abigail Doolittle. Well, Abigail will be looking at a variety, of mega cap tech stocks, hey?
We are indeed, and to do just that is Kevin Kelly of Benchmark Investments. Kevin, great to have you with us as always. And I was just taking a look at Alphabet. It's up for a second day in a row. This, of course, after the U.S. is essentially suing the company, accusing them of monopolistic behavior for their 90% control of the U.S. search market. And yet the stock could perhaps have its best 2 days since April. What are you seeing there options-wise?
So options-wise, you're actually seeing about 2 times the amount of calls being traded versus puts, and it's in the bullish direction. And one of the reasons why is it seems that investors are really focusing on earnings season coming up, which is on the 29th, and focusing on the actual advertising dollars that will be coming their way, because we've seen some preliminary read-through that most advertisers are still doing digital advertising versus TV advertising. So it's been very bullish for Google.
Yes, indeed. And it's interesting because Google on the year up 19%, Facebook up 37%. I know Apple's up closer to 60%. What are you seeing for Facebook there? Because it seems as though Google has been held back by the possibility of what in fact happened yesterday with that lawsuit.
Well, and that's another thing about Facebook, where they have regulatory overhangs coming their way, but investors are shrugging that off in the options pitch, because we're actually seeing even more bullish activity, 2.8 times the amount of calls, and that's going into earnings. So seeing it move, people are really focused on these big tech names that are irreplaceable in our entire tech ecosystem.
Well, that's pretty interesting that Facebook options investors are taking a play out of the Google playbook that traders may just not care if there is actually some sort of antitrust suit put into place. Well, speaking of earnings, Tesla today after the bell.
Yeah, Tesla's an even fascinating one, because you're seeing it come down to its bottom third of implied volatility heading into earnings, but it's still high relative to the overall market at about 80%. But you're seeing still very bullish activity, 1.8 times. And I think going into earnings, you're seeing that's what investors are focused on the option side, is actually this company is going to make earnings. So you're seeing very bullish activity in a lot of the momentum names.
Well, it's interesting, that stock hitting right down on the 50-day moving average. So perhaps that support will hold. And then finally, Kevin, a chart that looks a lot like Tesla's. C Group, well above its 200-day moving average, well extended, but it seems like you like the story, but a little protection going into earnings there.
Yeah, so given that this is a bit sort of the Alibaba of Southeast Asia, it's got an Amazon tilt to it too because it's a big e-commerce play, you're seeing that investors in the options pit are actually selling calls to the upside against it before earnings. So they're hoping they expire, but they're out of the money. So they're still bullish sentiment, but it's just sort of a risk mitigation going into it. And so what you can do here is buy the stock here around 166, 168, sell the December 190 call. You get a high implied volatility. You're going to take at least $7, $8 for that, lowers your cost basis, and you'll get an above average yield about 4.6%. So given that this company has done very well, but it's in the space you want to be, e-commerce, fintech, and gaming.
Well, certainly a very sophisticated strategy there. Kevin Kelly of Benchmark Investments, thanks for joining us for Options Insight. As always, from New York, this is Bloomberg.
It is our producer's favorite chart, so I did this just for all of us. It is that chart versus IPOs versus everyone else, and the story is relatively similar, Caroline. Take a look at this. IPOs have really jumped up. This is the performance since January of 2020. Year to date, you're still up about 76%. The S&P 500 is only up about 7%. And we got a new one today, Caroline Datto. It's a cloud-based data backup software developer. The IPO'd at $27 a share, and the last I checked, still trading still above that level.
Yeah, currently in the green, coming off of its highs up at about 18% at one point. Let's get to Datto CEO Tim Weller, who's live from the New York Stock Exchange with us. And Tim, you've gone public. I love the ticker is MSP. Talk to us about the focus on MSP. Of course, this is a business that basically delivers tech via the managed service providers, right?
Yeah, this is a very unique story. Our technology is built for small and medium businesses as end users, but it's entirely delivered and supported by a global community of companies called managed service providers, or MSPs, and hence the ticker symbol is a salute and a tribute to them.
And so give us a sense here, I guess, of the demand picture right now. I mean, you've been around for quite some time, but I guess the conversation right now about backing up data, protecting data, recovering data has probably never been more fervent than it is this year. What's the demand picture?
Yeah, basically what's happening is small and medium businesses are demanding the same technology that enterprises have, but they need it in turnkey, simple solutions. And when they move their entire companies to be digitally transformed in the online world, they need to protect that data, protect the assets, all the applications. They want great networking. They want to remotely monitor and manage all of that. And we've offered a broad suite of services, software as a service, in that area for many, many years. And so the trends of this year, even in a pandemic, seem that they would only accelerate that digital transformation and the opportunity for our partners, which are the MSPs.
Tim, it was interesting that you mentioned small and medium-sized businesses. Those, of course, are the companies that have been really hurt in part by this pandemic. I'm curious what they're telling you about their spending habits, how willing they are to spend, and then how much of a priority, of course, this is, given, we're in the middle of a pandemic and revenue is squeezed for some.
Yeah, it certainly is in some verticals, and I would say emphasizing the small, not the medium. Most of our end users are probably skewing heavily towards the medium size. Managed service providers will go after the business for those end users that care about uptime, car dealerships, insurance companies, lawyers, doctors' offices, and so on. And so we have found our providers to be very resilient throughout this pandemic, and they're also very creative and entrepreneurial. And so any kind of change at all, disruption, will create opportunity for them, and that's created very good demand for our services. But of course, we all know that SMBs are the lifeblood of any economy, and they're the job creator and the innovators. And so, we hope to see more broader reopening soon, and of course some stimulus for SMBs as well, so we can keep cheering for those small businesses.
Tim, yeah, you service more than 1 million of those small and medium-sized businesses. Where's the competition coming from for you?
It comes from a couple of areas. In many cases, they might have rolled their own, as we say, where basically they're putting together their own technology and trying to do it in-house. But unlike enterprises who can sustain a CIO and a large IT department, even medium-sized businesses have found it very difficult to keep up. So the managed service providers become virtual. So in some cases, it's just a matter of one of our providers going in and pulling all their technology stack together. We do have a number of competitors, though, in each individual technology that we offer. We just tend to offer a broader range, and our lens is through the managed service provider. So we design it all for them to easily deploy and maintain versus having to maintain a wide variety of vendors in their stack.
All right, so your company getting a lot of attention now that it is a public company. A lot of secondary market investors are going to start kicking the tires to see whether this is the stock that they want to be in. What is the sort of, I guess, the selling point you think that investors would look to? Is this about the revenue growth story? Is this about profitability? Is it about margins? I mean, what's the general strategy here for creating shareholder value going forward?
Yeah, I would call it a growth at scale. We've come through now $500 million of recurring revenue in terms of ARR. We are a creator of technology, and the managed service providers are $137 billion globally, and that number, according to analysts, is poised to double over the next 5 years. Our TAM within that is about $28 billion and should grow at least that fast, if not faster, as we roll out new technology. So it's a growth at scale into a very large total addressable market with an incredibly unique channel. We are the largest pure play company serving this MSP industry, and when they grow, we grow.
And is it growth at any cost? What is the pressure to be profitable?
Yeah, we have been quite profitable in our history, and this year we actually expanded our margins. I wouldn't call it growth at any cost, but as you know, the public markets have been very receptive to software as a service, and we generally are going to be pushed by our investors to grow faster and defer ultimate maximum margins and profitability. So we've got enough profitability inherent in the model that we know we can get more international and launch new technology and still remain nicely profitable.
All right, newest member there of the NYSE, Datto CEO there, Tim Weller, cloud-based data backup software company, shares here right now trading right around $28 a share. Let's take a look right now at the broader market and where we stand right now. The S&P 500 kind of middling around, pretty much open flat, took a pretty big bid higher, moved lower, and now back up. All this, of course, Caroline Taylor, seems to be all about that stimulus deal and whether it's going to show up, Taylor.
Yeah, shocking. Someone had a good point. If you look at the intraday chart, it kind of makes you seasick, the whip sign that we get. But Caroline, I put all my attention, of course, on that reflation trade. You have a lift up of 3 basis points. You're now up to 81 on the 10-year, a 162. I mean, you're really starting to approach near the highs, of course, that we saw this summer.
Certainly. I mean, keeping a close eye on where we are in these levels. Also looking at crypto as PayPal seems to give its doth of a cap, and we see Bitcoin currently up 7%. We're not showing it right now, but I'm all about Brexit still, guys.
Is that still going on?
It's still going on. And actually, there might be an agreement by November. Pound goes higher. This is Bloomberg. This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick, counting you down to the last half hour here of the trading day, Caroline.
27 minutes to go. Let's look at where we trade in terms of the NASDAQ. Well, we have back in the green. We've been whipsawed and up, down, round we go as we continue to see whether stimulus talks are on, whether stalemate can be broken, and whether a deal will be forged within 48 hours. I'm looking across the pond because Brexit's still ongoing. We had some news that sent the pound to the highest that we'd seen, well, biggest move that we've seen since March. This jumping as UK and EU do agree to intensify their trade talks. The goal is finding a deal by mid-November. The saga continues. Crude oil down by 4%. Meanwhile, we're seeing copper futures. I look at them up 1.6%. This is trading near a 2-year high on supply disruptions in Chile.
Yeah, it'll be interesting to see what happens first, a Brexit deal or a U.S. fiscal stimulus deal. The S&P 500 has been pretty much batted around on this. The one pocket of strength in the S&P 500 is that communication services sector, the Facebooks, the Alphabets, the Disneys, basically a lot of these ad platforms. Snap up 31%, not in that index, but it was those earnings that actually sort of underpin the rally that we're seeing in that sector, up 2%. And of course, a big story taking shape here in the Treasury market, Taylor. 10-year yield at one point was up to 83 basis points. It'll be interesting to see whether this sort of reflation trade and the steepening that we've been seeing, particularly on that 5-year, 30-year, continues, particularly if we don't get that stimulus deal.
Yeah, huge. We're going to circle back to earnings as well because Verizon exceeded Wall Street profit estimates and raised its full-year earnings forecast, all in a sign that the company's focus on mobile and broadband network services is helping it weather the COVID-19 pandemic. We spoke earlier to the CEO, Hans Vestberg, about just this.
Give optionality on everything we're doing. We're working with all the top brands that our customers want to have. That's how we work, and we have the best distribution, the best network, and an A brand. That's why we have all this partnership, and that's why we had our partnership with Apple last week. We have had our partnership with Amazon. We just announced also that we're working with Microsoft on the 5G mobile edge compute. So that's how this market is working, and that's our strategy. Our strategy is a network as a service, and we work with all these prime brands to give to our customers, and we monetize it.
I'd love to get your perspective, Hans, just though on what you think of the antitrust case against Google and sort of the animosity in Washington among big tech, and how that may affect you in the longer term and your relationship with Google, or the money that you wind up getting from Google to put their search on your phones. Can you talk me through how you're thinking about it?
No, I've seen the same news reporting that everybody else. I have no insight to what is DOJ is claiming, etc. So I have no comments on it. We're working with all these different companies, and Google is one of them. So no, I have no comments on it.
Okay, unfortunately, we're not going to let this go just yet, Hans. Do you have a revenue sharing agreement with Google to install Google Search as the default option on the new phones that you send out?
We have a long relationship with Google when it comes to different type of application. Of course, Android is used on all the phones that is not the iPhone. So we have a commercial relationship with them, yes.
So I understand you're not going to give us the hard number. I think just the reason why we're harping on it is because if we do get some pushback from DC, from the likes of Google, for example, and how they're able to distribute their search engine, that's going to affect your phones. It's going to affect how consumers react to it. I mean, there has to be some contingency plans or something.
Whatever decision comes out from a process like this, we will cope with that. We work with many different decisions in our industry over time, so there's nothing unusual. But yeah, hey, we have only seen this for one day, so let's see this through what's going to happen.
Final quick question. Let's talk about the numbers. Hans, what was behind the improvement in guidance that you've delivered to the market today? What is the factors that are driving it right now, and how sustainable are they? You've talked about 5G. Is there anything else?
No, I think that we're on a good trajectory in all our businesses, and you saw that our service revenue actually was coming to growth in the third quarter, even though it was 7.7%. It wasn't very important because we improved from July to August and August to September. So we are actually moving, and it's all our areas. I mean, clearly what you see in the consumer side, we're now improving. On the business side as well, we're improving, and then on the fixed broadband, our Fios had a record quarter, the best in 6 years. Much of it is driven on what is needed right now in this market when both comes to wireless infrastructure or wireline infrastructure. So we are very happy with that. And we also saw our media companies actually doing good in this quarter, improving from coming down the high double digits up to 20% in the second quarter, and now down 7% and improving in the quarter. Many of the assets like Yahoo Finance, Yahoo News are improving dramatically when it comes to users on the network. So it was many factors, and we continue to have a good cost control in the company. So that's why we can see a good quarter coming. And then, of course, we're adding that with the iPhone launch that is coming in the fourth quarter this year. Last year it was in the third quarter. That's why we see a good trajectory and a good base for going into 2021 as well.
Hans Vestberg there, Verizon CEO and Chairman. Let's have a quick look at the breaking news we had during that tape. AstraZeneca and Johnson & Johnson trials to restart this week, we understand. This as, of course, there was news that AstraZeneca's COVID-19 vaccine had a participant in that trial had died, but it was unrelated in Brazil. We forge forward. AstraZeneca still down 0.8% though.
And some other breaking news here on Apollo Global Management. Cambridge Associates, the investment advisory firm, saying that it may stop recommending Apollo's funds. This apparently over some concern about those reports linking Apollo co-founder Leon Black to financier Jeffrey Epstein. We'll dig a little bit deeper into that coming up later. This is Bloomberg.
This is Bloomberg Markets The Close. I'm Scarlett Fu with your ETF Intelligence, where we examine market trends through the lens of exchange-traded funds. And it's a big week for 5G. Verizon and AT&T report earnings, while Apple's new 5G iPhones become available. And of course, there's a bunch of ETFs tied to this theme. Sean O'Hara, who is president of Pacer ETF Distributors, joins us now. And Sean, you've got an ETF that just passed $1 billion in assets and focuses on the infrastructure build-out of 5G networks, but notably, it's not a tech fund. So explain the objective of the fund, SRVR, and how it taps into the 5G theme.
Sure. Well, thanks, Scarlett, for having me. The 5G theme is a part of what we think is a bigger transformational technology revolution that's also linked to artificial intelligence and streaming, the cloud, the Internet of Things. All of those things need more computing power. And all computing power in the future looks like it's going to come primarily through the cloud and through data centers. So we put together an ETF that focuses on the mission-critical infrastructure that allows for these technologies to continue to thrive. So we own data centers, which is where the computing instances will take place. We own some fiber optic names, which is the link, if you will. That's the information superhighway. And we own the cell phone tower names, because more and more of us are going to start using our device for more of these things as 5G completely rolls out.
I'm looking at how it's done so far this year, up 13%, the best performing real estate ETF. And in fact, only 3 out of 47 real estate ETFs are in the green, and you guys have 2 of them. Server yields 2.3%. That's much lower than the average 3.8% yield of the 5 biggest real estate ETFs. Is this a bug of the ETF that you have to give up some yield in order to access that growth?
Yeah, I think that's exactly what's going on. You're trading traditional real estate, which is sort of, based on financing and inflation driving the asset price up, for a growth opportunity. When you start to think about the number of data centers that will be built, how the continued build out in fiber has to happen for things like streaming to continue. And as you start to think about the big build out in the towers that are necessary, not only do we need more cell phone towers, but we need these micro towers in between the traditional big towers and more tiles on the towers. And so that's all good news for the cell phone tower companies, because they're just going to get to basically charge more rent for the existing infrastructure. So it is a trade-off. Traditional real estate probably has a higher yield, but we believe this has got a good long-term growth prospect ahead of it.
And in fact, it might be a substitute for real estate in your portfolio. I want to talk about another Pacer ETF, which is the Trend Pilot U.S. Large Cap ETF. My colleague Eric Balchunas likes to call it the airbag ETF because it uses technical signals to switch to cash in a severe sell-off and then back to equities in a big upswing. If you look at the chart, though, it is trailing the S&P 500 year to date. The airbag popped, but then it was too late for the recovery. You have since rewired the fund. What did you change?
Well, this is the second enhancement to the methodology that drives the trend pilots. We used a 200-day simple moving average. The original version had an all-in or all-out approach. We added a 50-50 position before we rolled it out as an ETF that dealt with some of the corrections, and then trying to apply the lessons learned from this market. The market sometimes gets into these extreme positions where it's really far above its moving average or really far below its moving average. And if it's not like a traditional bear market cycle where it takes a couple of years for things to work themselves out, where we had in 2020, 45 days from the bottom to a new all-time, start of a bull market, we tried to apply those lessons. And we added an extreme valuation trigger that will reduce the risk when the market gets too high, enhancing the airbag feature, if you will. But also, if it gets below 20% below its moving average, the portfolio will put half the money back to work in equities. And that should help us get the return off the bottom when we get in these extreme market conditions like we went through in 2020.
Gotcha. So it's a little more sensitive to the moves in the market, which seem to feature more corrections than actual crashes or surges. Thank you so much, Sean O'Hara, president of Pacer ETF Distributors. From New York, this is Bloomberg.
Countdown to the close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick.
And we are suddenly losing our gains, whipsawed around today on the headline risk that is stimulus. Is it stalemate? Is it a deal in 48 hours? Suddenly, towards the end of trading, we are dipping below the break-even level for the S&P 500, NASDAQ, and the Dow. Currently leading us lower is the Dow Jones, off by 0.25%. We continue to wait and see whether any sort of stimulus deal can be done, Romaine.
Yeah, seeing a lot of the sectors move lower here. There are a few bright spots here. I want to start off with that one. That's the one at the top of your screen. We've been talking a lot about this monster gain in Snap, up about 30% on the day, and a lot of the platforms rallying, like Pinterest, Twitter, et cetera. But the ad agencies also rallying. These are the digital media companies that help to create a lot of those ads for these brands that end up on those platforms. So Interpublic up about 3.8%, Cardlytics up 4%, Fluent up 2%, Trade Desk up about 2% as well. So a big rally going on in that space on the idea here that ad spending is intact. You see the Bloomberg Galaxy Crypto Index up about 6.5% on the back of that news of PayPal putting, I guess, giving a little bit of a hug to Bitcoin. Home builders taking a leg down here on the day. Some mortgage bankers index data showing that home purchase loan applications actually dropping in the most recent week, the 4th straight weekly decline. Some evidence here that maybe there's a little bit of concern here that housing boom that we've been in might be on a little bit of a breather, Caroline.
Oh, one to watch. Let's get more market analysis. That was really across every industry group. But Diane Jafee is here with more, Senior Portfolio Manager at TCW. Diane, it's always great to have you with us, of course. Talk to us a little bit more about your focus on these headline risks, the focus on stimulus. Does it matter to you whether you get the stimulus before or after the election?
Well, I think for nearly 12 million people, it would be a great idea to have it the sooner the better. But for investors in the market, I believe that it's coming, and so if we have to wait, then we have to wait.
So, Diane, right now, this is a market that does seem to be batted around, at least on a short-term basis, on the outlook, not only for fiscal stimulus, but there is obviously a broader read here into the economic recovery and whether it can sustain itself. I guess when you look a little bit further out, beyond just whatever Washington does over the next few days or weeks, do you think the economic recovery is intact, at least as the market is pricing in?
I do believe the economic recovery is intact. I do believe there's a flood of money that's already circulating through the system, where the gate really is, the health and how we are being able to treat the virus, whether it's better protocols or with a vaccine. AstraZeneca and Johnson & Johnson just announced that they can restart their trials, so that's positive. But there will be a portion of the economy that is going to suffer, the smaller retailers, the smaller businesses, leisure, and that is going to take some time to heal.
Yeah, right now we're speaking here with Diane Jafee, Senior Portfolio Manager over at TCW. We're going to continue that conversation with her in a moment, Taylor. But stocks right now are pretty much flatline on the day after being higher for a good portion.
Yeah, what a reversal it's been. So you immediately go to the VIX, of course, which is still falling on the day, about 0.8% to a 28 handle. But then, of course, we push that curve out further to the November to the December contracts. Take a look. You have seen a little bit of a rollover recently, of course, as some of the election jitters and fears have calmed down just a little bit, but we're certainly off the lows that we've seen. So some of this volatility that we see today certainly back in focus, and it is all back in focus for shares of Tesla. It is my stock of the hour flip of the board, and really we've had Colin Rusch of Oppenheimer, analysts, really opining about this. You've had record third quarter deliveries. Can you get to 500,000 deliveries this year? How much revenue growth do you get from China, from the Shanghai factory really ramping up? Of course, you've had some subsidies as well come down. And then that analyst really focused on the margins, right, and how efficient those factories can become. So shares there up about 2% for stock of the hour. And finally, as we talk about Tesla, some of these high-flying growth stocks. And Diane, I want to bring you back in here on this chart. A transition lately. In the last 2 months, you've had the equal weight index relative to the market cap index outperform. You've had the Russell 2000 relative to the S&P outperform. Is this sort of a healthy broadening out of this rally that you see here?
This is something we measure and track every day, and we agree wholeheartedly that this is healthy for the market and healthy for the economy. And it's following earnings. The mid-cap, large-cap stocks actually have better growth, maybe coming from a lower base, as do the small mid-cap stocks. In fact, the mid-cap estimates and small-cap estimates have increased 15 to 20% from the end of Q2 going forward, and that's better than the S&P 500, which is only up. Estimates are only up 1 to 2%. So broadening out of the markets and individual stocks, going down the cap structure is a wild positive, I think.
Wild positive. Interesting. Talk to us about the opportunities that you see, whether it be the US or looking further afield. Have there been, we've always talked about money coming in from the sidelines. We've also talked a lot about the weakening in the US dollar. I mean, some statistic at how much we're seeing a weakening in the US dollar versus the Chinese yuan, for example, at the moment. How much does FX feature into what you're doing?
Absolutely. The weakening of the dollar is great for any company that has exports. It's great for any commodity. We've seen a stealth recovery in value stocks, first from the industrial names in June. They've really been picking up in terms of garnering investor interest with able to handle the blow from Q1 and Q2 economic downdrafts, and as well as looking forward, and how they're better prepared in the future. Then we've seen materials start picking up. Dr. Copper is known that way because it helps investors look at the macro point of view in terms of economic growth, not just in the U.S., but worldwide. And copper is over $3.15 a pound. That's a big, big move from lows we saw early in the year, closer to 2. So I agree with you that we are seeing stealth recoveries in different pockets of the economy, and it's going to translate to, with lower dollar, it's going to translate to better overseas sales for multinational companies.
Yeah, I am curious. Looking at copper here in New York, $3.19 a pound is where futures are trading at the moment here. But some folks, Diane, they've also started to look a lot more closely at the energy sector as being a little bit more of a barometer of economic health here, in the same way that maybe in previous cycles they looked at copper. And right now the message coming out of the oil market isn't necessarily encouraging.
Agreed. But we are so oversupplied. Of course, it was of national paramount importance, under the Obama administration to be self-sufficient in energy, so we wouldn't be tied to other nations who might or might not have our interest at heart. And that really, started forth a whole huge amount of exploration and a lot of supply. But there needs to be consolidation. And I think that, we've seen Chevron announce that it wanted to acquire Noble. We've seen Parsley Energy just be taken over or announced its acquisition intent, and I think that's the 4th or 5th one so far in the last month or so. So consolidation into better balance sheet players, I think it will be the start.
I'm trying to figure out within your world of equities how you take a look at the 10-year. On one hand, a higher discount rate means you have lower present value of cash flows. But if a higher 10-year yield means higher growth expectations and better earnings, then that could be a positive for equities. How do you view this reflationary higher yield within your equity portfolio?
Yes, we take the steepening of the yield curve, to be a positive for the overall economy. Of course, it's really tied at the short end by the Fed for years to come. But we do believe that it's a barometer for better economic prospects, and we are going to get our first taste of Q3 preliminary GDP on October 29th, and the estimates for that are anywhere from 10 to 15% on the low side, up on an annualized basis to 30-35%. So, and there's more to come even without the stimulus package, maybe 3 to 5% in Q4.
Interesting. And many sort of talking up potentially the resilience of the economy with or without the stimulus package. We're currently 30 seconds out from the market close. Communication services up by 1.4%. Consumer staples also clinging into the green, but every other industry group is in the red at the moment. We're dragging the S&P 500 down by some 7 points, Romaine.
Yeah, and we've had about a 31-point swing here on the S&P 500 from peak to trial. Seen basically going to close the day out relatively flat here, down about 7 to 8 points here. I thought it was kind of interesting, though, that when you look at the earnings that we had last night, we were all sitting here when we had Netflix come in and Texas Instruments, not good at all. Then, of course, you had Snap come in, and that really changed the thesis for a lot of folks. And you saw some rotation out of some of the more, I guess, bigger cap tech names into some of maybe these, I guess, I don't know if you call Snap a mid-cap name, Taylor?
Yeah, what,
$45 billion
market cap. Yeah. Well, I was just, trying to
Yeah.
get my head around more users on Snap than on Twitter. But, you sort of fold that over into the idea of Chipotle, which is, of course, another earnings that we're waiting for. And this idea of that digital transformation that they've undergone. And I know we focus so much on Tesla because that's the high-flying stock. But in terms of, we used to all go and eat in the stores there, and now really that ordering online, the delivery, and that innovation and that digital transformation sort of weaves in this theme of this COVID era that we're in, about this transformation and how these companies are adapting, Romaine.
Yeah, and of course, we're waiting on Tesla, which closed flat on the day after being up a couple of percentage points. Lam Research, as well as SL Green, which is a big office REIT here in New York City, I believe the second largest here. So it'll be interesting to see if that gives us a read, Caroline, maybe on reopening, if at all. I don't know.
Yeah, let's take Diane Jafee's take as we expect the earnings to come thick and fast any moment. You've been talking about the opportunities, perhaps not always in the US, looking further afield, looking for potential. What do you want to hear from companies right now? Is it forward-looking guidance when they give their earnings? How much can you expect them to beat where the analysts had laid their earnings per share and revenue expectations?
Well, we always love it when companies under-promise and over-deliver, right? And so there are still some big unknowns in terms of future guidance. But, you know, having a blank slate and letting investors do all the guesswork is disconcerting. So we do need some guidance, at least, you know, some floor that we can look for going forward, and then maybe outlining some future possibilities in terms of the upside.
And just to be clear here, I mean, for those folks out there who aren't traders, they are long-term investors. They're creating a portfolio, and they're trying to sort of balance out that portfolio. Where is that balance sort of created right now, you know, between equities, between fixed income, between commodities, et cetera?
That has been a big topic of debate because the absolute level of yields is just so darn low that you're wary of locking yourself into sub 1% interest rates, you know, let's say for 10 years. So the old paradigm of 60-40 has been debated pretty voraciously over the last few months. And so you want to keep the riskiest assets to be the smallest percent of your portfolio. You always want to have liquidity for the next 1-2+ years just to make sure you can sleep at night, and importantly, not have to sell your equities, which are your longest duration asset, when there's a crisis like COVID in Q1. So I think investors, individual long-term investors, have to think about their current needs, make sure that they don't have to sell when it's the worst possible time to do it, and invest in good quality companies over the long run.
Finally here, what is not priced in these markets?
I think that because we're still seeing such back and forth with the stimulus, that investors are still nervous about the economic outcome going forward. So if we get, and yes, stimulus is important for the people who've been most severely hit, but if we get confirmation that the economy is rebounding, and I think Q3 GDP and expectations for Q4 and into 2021, I don't think that's priced in. I think everyone's still nervous that we're going to sink right back to March lows again.
Diane Jafee, we want to thank you, Senior Portfolio Manager at TCW, taking us through the close, and there's plenty more still to come. We are awaiting those earnings. Keep with us for Chipotle, for Tesla. We'll be digging into the details of Bloomberg Markets. This is Bloomberg. Let's check how we close these markets. It was a topsy-turvy day, all hit really by the headlines, whether we'll get a stimulus deal within the next 48 hours. We closed lower. No one wanted to be long risk, it would seem. We bought up social media. We sold off energy. S&P 500 down 7 points. We're getting some earnings crossing the wire, Romaine.
Yeah, let's start with Lam Research, of course, a maker of equipment to make semiconductors, reporting earnings. 1Q revenue coming in at right in line with estimates, $3.818 billion. The adjusted EPS number coming in slightly higher than estimates at $5.67 versus an estimate, Caroline and Taylor, of $5.19.
And Tesla breaking. Third quarter basic earnings per share, 32 cents versus the 80 cents. Their revenue coming in at $8.77 billion. That is indeed a beat for their third quarter. Earnings per share coming in at 27 cents. We want to see adjusted earnings per share of some 55 cents. So we'll see how that tallies up. That actually adjusted earnings per share was 76 cents. So they beat in terms of the expectations for adjusted earnings per share. And this is a company, of course, we want to dig into the details of overall profitability, whether this was really on strong deliveries or whether this is more supported by the fact that they got regulatory credits, Romaine.
Yeah, it'll be interesting here to see kind of what they say going forward, particularly with some of those deliveries, Taylor. A lot of folks, of course, are focused on that profitability number, that EPS number, because a lot of folks, of course, want to know if this is a company that does finally make it into the S&P 500. 5 straight quarters of GAAP profitability, but Taylor, of course, a lot of folks questioning just how sustainable that is.
Well, and they say here that delivering 500,000 vehicles in 2020 remains the target, and we do that if we want into the board here, into the terminal, where we know that we got 139,000 record deliveries last quarter. So, of course, waiting to see how close that 500,000 would be really here for the full year. Let's bring in our Bloomberg Technologies Ed Ludlow. And Ed, of course, numbers just crossing the wire. Talk to us, of course, sort of what sticks out to you, the vehicle deliveries, the focus on the China revenue growth. What do you make of these numbers?
So Tesla says we have the capacity installed to produce and deliver 500,000 vehicles this year. While achieving this goal has become more difficult, delivering 500,000 vehicles in 2020 remains our target. I think analysts across the street saw that as being a bit of a heavy lift for Tesla going into the fourth quarter. They will have to deliver 180,000. But look, like one of the big takeaways from the whole pandemic period basically is that Tesla has got better at manufacturing vehicles. I don't think the profit number was a surprise, given the record delivery last quarter. We also know that there's higher margins on the China-built Model 3s, for example, as well. Regulatory credits once again played a role here. If you look at the number, I think it's coming in at around 350 million for that regulatory credit revenue. And that's what analysts want to know, and I think we'll address it more on the call going forward, is Tesla going to be consistently profitable on an ongoing basis if you strip out those regulatory credits? Our colleague Kevin Tynan, Bloomberg Intelligence, has been talking about this on the blog. If you take GM, for example, as they catch up in electrification, the idea is not about them taking market share, but as they expand their capacity quickly, we know that GM's got this great command of the supply chain, they're simply not going to need to buy regulatory credits. FCA, Fiat Chrysler, yes, they're a bit slow off the mark with electrification, but eventually there won't be a need for them to buy them. And so the question is, will Tesla be profitable just from building vehicles?
Yeah, and so, I mean, the other issue that's sort of standing out there, Ed, was, of course, the liquidity issue. I mean, it does appear that cash flow is in a pretty healthy position, and that maybe buys Tesla a little bit more time and a little bit more grace with investors.
Right, but investors will look along beyond this quarter as well. Elon Musk put the narrative around this company firmly on growth, right? And it's not just about growing the audience of Tesla users around the world, but in Shanghai, they want to expand to the Model Y line there. They're building a factory in Berlin to service local European demand. They want to get this factory done in Austin to bring the Cybertruck online, expand the portfolio of products, grow the addressable market, and that all takes money. One of the advantages that analysts talk about time and again with Tesla is their cost of capital advantage. The run-up in the shares this year, which has been extraordinary compared with some of their automotive rivals, gives them that cost of capital advantage. But also, analysts have been calling on Tesla to deploy that capital. So we'll be wanting to hear a narrative and commentary around CapEx about where that pace of growth is going to come from. And then there's the demand question. The tactic used during the pandemic period has been price cuts, both in China and in the US. US is the more mature market, but we've not really seen any revenue growth there for some quarters now. So what's going to drive demand? It's early adopters, right, that are buying electric vehicles in North America and in China as well. So when are we going to make this sort of a broader shift to electrification and EV adoption from those consumers? I think those are all topics that are going to come up on the call, as well as full self-driving. When is Tesla going to actually act on this narrative around autonomy and this lead, which it has sort of hinted at for some quarters now that it has?
And of course, many wanting to know about this Cybertruck here, Ed. We've all been looking at the GM Hummer and re-watching how it takes certain hills. But really, this is going to be an area of focus. You mentioned the Model Y, how that's coming online in Shanghai. But we're going to look at the Cybertruck too, hey?
Yeah, this is an area I'm really focused on because you just have to think about what Americans are buying right now. Almost 80% of purchases of new passenger cars are light trucks. That's a pickup truck or a large SUV. But if you look at what's out there in the range of EVs available for you to go and buy today, they're all sedans and hatchbacks. And it doesn't really align with what consumers are looking for in a vehicle. The golden rule of electric vehicles is price parity and performance. The electric vehicle has to cost the same as a traditional combustion engine car, and it has to be able to do the same. And I think it's really interesting to see General Motors focus first on the Hummer EV, the Cadillac Lyriq, and then you have Ford talking about electrifying the F-150, Rivian bringing its R1T pickup to market. Those are more in line with what consumers in the US want. And electrification in the US is behind the curve when you compare it with China and Europe, where sedans and hatchbacks are more prominent, but then Tesla has more competition in those markets with a broader range of models from rivals.
Ed, taking us around the world in terms of electric vehicles, thank you so much coming live from us from San Francisco on all things Tesla. We've got to bring you plenty other headlines coming. Stimulus, of course, this is what was whipsawing the market all day. Pelosi and Mnuchin, Treasury Secretary Mnuchin, plan to speak again tomorrow, according to aides. Now, we know that actually the deal seems to be getting closer at the moment. We are hearing from Nancy Pelosi's aide in particular that talks are getting closer to being able to write a bill, Romaine.
Yeah, interesting that she says that, because we heard from Mark Meadows, of course, Chief of Staff to President Trump, saying a little bit earlier that there was still some distance between the Republican members in the Senate and whether they would actually agree to some of the terms. So it'll be interesting to see how that gets reconciled. So keep an eye on stimulus. Taylor, you're on burrito watch, aren't you?
I am lining up for our burritos at Chipotle around the corner. This is interesting. Shares are off 3%, but it looks relatively tame for their earnings. Comp sales are up 8% versus an estimate of a 7.5% gain. On an adjusted earnings per share, they're seeing a beat on the bottom line. Unadjusted, they are not. They are opening up 44 new restaurants, closing 3 restaurants. That all happened in the third quarter. So again, some improvement on the top line, a little bit of a miss, of course, on the bottom line on an unadjusted basis. Still looking to see, of course, why shares would be off about 5%. I'll keep digging.
Yeah, I don't know who's not buying burritos, but Chipotle right now, one of the biggest movers to the downside in after-hours trading, one of the biggest movers to the upside in after-hours trading, Whirlpool. Remember, this is a stock that has already tripled off of those March lows. Everyone's, of course, remodeling homes, buying washers, dryers, and the such. Up 6% here. They're actually reinstating their guidance for the year. Full year 2020 organic net sales will be 0% to -1%. Net sales decline of 5 to 7%. But that's actually better than what some folks expected. Ongoing EPS, $7.50 to $18 a share. So that's the forecast. The Q3 numbers, I should say, for the most part, pretty much topped estimates. I won't go through all the numbers, but generally you had about $5.3 billion in net sales, well above analyst estimates of about $4.8 billion, and that EPS number coming in at $6.91, above the $4.20 estimate that the street was looking for, the consensus estimate there. And you can see the shares here up 4.5% here. In after-hours trading. All right, we're going to get to some more earnings a little bit later, but now we want to go over to Mark Crumpton, who's standing by with the Bloomberg First Word News. Mark?
Romaine, thank you so much. As you and Caroline were just alluding to, House Speaker Nancy Pelosi says she, quote, has a prospect for an agreement with Treasury Secretary Steven Mnuchin on a coronavirus package, but it may not come together in time to pass both chambers before next month's election. The White House Chief of Staff, Mark Meadows, says the administration wants to have an agreement within the next 48 hours. A few sticking points remain, including the scale of funding for state and local governments. New Jersey Governor Phil Murphy abruptly stepped off the stage of a public event today, moments after he learned somebody he was in contact with over the weekend tested positive for COVID-19. Governor Murphy said the last time he took a COVID-19 test was on Monday and that he tested negative. It's unclear how long Murphy intends to quarantine or if other members of the governor's staff were also exposed to the same person on Saturday. The UK has agreed to restart Brexit trade talks with the European Union. The first phase of negotiations will take place in London beginning tomorrow. The two sides are reportedly hoping to reach a deal by the middle of November. The Justice Department announced today that Purdue Pharma, the company that makes OxyContin, the powerful prescription painkiller that experts say helped touch off an opioid epidemic, will plead guilty to federal criminal charges as part of a settlement of more than $8 billion.
The global settlement announced today involves the company pleading guilty to 3 felony counts for defrauding the United States and violating the anti-kickback statute from 2009 to 2017. In addition to the company having agreed to plead guilty to these 3 felony counts, the company has agreed to a $3.544 billion criminal fine and a $2 billion criminal forfeiture amount.
Court papers and federal officials say the company's owners, members of the billionaire Sackler family, will pay $225 million in a civil settlement with the Department of Justice. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
We want to bring you more clarity, of course, that we're getting on earnings, and I'm following Chipotle, which interestingly, we had seen same-store comp sales, you guys, of about 8.3%. That was beating an estimate of about 7.5%. But we are hearing that their third quarter earnings per share was perhaps maybe a bigger miss than we thought at about a $2.82. The company saying, of course, this is due to restaurant asset impairment, some enclosure costs, some other corporate restructuring. So that's giving them a diluted earnings per share of about $2.82. Interesting fact, digital sales up 202%, 200%,
Wow.
and accounting for about half of the sales for the quarter, Romaine.
Yeah, to the downside, 4.5%. To the upside, Whirlpool, one of the big movers here in after-hours trading. That company reinstating guidance for the year, basically giving a guidance on sales as well as EPS that's coming in above analyst estimates. This is a reported 3Q numbers that also came in above analyst estimates, both for sales and EPS. Another interesting mover here, moving even more than Whirlpool, is Align. This, of course, this is the maker of Invisalign, the teeth straightening service here, up 19%. Remember, there was a lot of debate here last quarter about the sustainability of this run in these shares, which were already up about 143% prior to today. That company coming in today, right now, Caroline, 3Q net revenue, $734 million. The estimate, consensus street estimate, was $533, so a big beat there on revenue.
Amazing. And let's now focus in on Tesla, because this is the one everyone was going to focus in on. It really blows past the estimates in terms of its revenue, its earnings, its cash, its positive free cash flow. We're looking at the regulatory credits once again supporting their profitability, about $397 million. But cash up to $14.5 billion. They're going to have no issues meeting those debt maturities, guys. And I think notable for the street was 500,000 deliveries is still what they're focusing on. Wow. Yes, it's going to be hard. Yes, pulling 180,000 in fourth quarter is going to be tough, but they still stick to it, Romaine.
Do you have one of these Cybertrucks yet?
Not yet.
Not yet.
On order.
On order. What is that going to cost? Like 100 grand?
Small amount, small fry.
Taylor, you're definitely not a Cybertruck kind of person. You're like a Miata person,
Don't judge a book by its cover.
Little Porsche Boxster.
She's more of a Ram. I'm sure she's got a Ram.
All right, well, Tesla, of course, Taylor, I mean, we're going to talk a lot more about this through the afternoon.
Yes, we are. I think, is it time for smart charts now?
I think
Not quite yet. We were gonna ramp up a little bit more about Tesla, guys. We were going to be talking about where the stock's going, what you think about whether you're purchasing the Model Y, whether you're going to be making them in China.
We could go on all day. What about avocado prices?
No, this is very serious. This is in the press release of Chipotle. They're seeing a decrease of avocado costs and lower salsa usage.
Lower salsa usage?
Why? That is a key statistic.
Is that a good thing or a bad
margin
thing?
Analysis.
Huh. Interesting.
Tomatoes don't go along.
I feel like we should devote a whole segment to that. way to tease it, Taylor. All right, I think we have to jump over to Abigail Doolittle. I'm sure is tired of listening to us talk about avocados and salsa. So she's here with Smart Charts, where we take a look at the timely topics through the charts. And Abigail, you're looking at Tesla.
We certainly are, and I certainly will not be buying that Cybertruck. To talk about Tesla, though, and the markets more broadly, Todd Stone of Strategas Research Partners. Todd, great to have you as always. And before we do talk about Tesla and the chart that you have of that overextended stock, you think lots of what's been happening recently is noise for markets, and investors should look past it.
Yeah, thanks, Abigail, for having me on. Much appreciated. And as you said, there is a lot of noise no matter where you look. I think that's rightfully so, given the environment we're all living in. But if you look within the equity market indices, we like the overall risk appetite we're seeing. You have semiconductors outperforming, discretionary outperforming staples, industrials and materials stocks have been very strong. And the participation from the average stock has been just good enough for us to feel confident what's going on down the cap scale. Tie that all in with what's a powerful fourth quarter seasonal. And to us, that means you have to use any sort of choppiness over the coming weeks to add on pullbacks, right? Don't get confused with any sort of major top here because we just went through that bear market. So we like the risk appetite. I get put calls might be one risk. That's not enough to derail the market in our view.
So net, you guys are constructive going into the end of the year. And a piece of the constructive tone on the year, in fact, the top stock for the NASDAQ 100, Tesla, going into today's earnings report up more than 400%. Right now, a relatively muted earnings reaction, up 2.2%. Let's see what you think is ahead for the shares of Tesla.
Yeah, if there's anything we've learned about that stock, it's that it's the ultimate momentum and mean reverting name. And you never want to fight momentum historically, but in this case, we just want to be on guard for future mean reversion. For example, Tesla's about 80% above its 200-day moving average. In 2013, that went upwards of about 180, 190%. Eventually, it corrected back to the 200-day, right? Earlier this year, you saw it get to a similar level, around 200% above the 200-day, and then revert back sharply. Now, you don't necessarily have to revisit the 200-day in this case, but with this meaningful premium to the 200-day of around 80%, just know your risk here, know your stop limits. I think the initial support, we look to 330 if we do get a correction here over the coming weeks. Let's just keep that in mind with a momentum name like Tesla.
Yeah, it's also interesting the way that you have this charted out in terms of the spread between the stock and the 200-day moving average, lower highs, similar to what happened earlier this year. So maybe making the case for some of that caution. Now let's take a look at the FANG complex overall. Of course, Tesla's a big piece of that relative to the S&P 500.
Yeah, great batch of names when you look at this index. I think it's about 10 or so stocks, including Tesla. Heavyweights in the market, Apple, Amazon, Google, Facebook, perhaps extended in a similar scenario to Tesla, not as extreme. But again, don't confuse this sideways consolidation with a major top. These are all great names. You want to use the index pullbacks to start to add exposure here. You know, I think if they do correct, it would create an opportunity for the average stock, maybe even the value factor to pick up the slack. That won't help the actual S&P 500, but it does help overall participation. Now, I think it is interesting if you're worried about Tesla or Apple, that there is some emerging strength from a name like Twitter or Baidu, which is part of this index. So if you're looking to diversify away from the big names in here, there's still opportunity within this FANG complex that's really interesting to us.
Right, choices. But it sounds like you think the big is going to get bigger, and there might be a breakout ahead for the FANG complex. Todd Stone of Strategas Research Partners, thanks so much for joining us today for Smart Charts. Taylor, back to you.
Thank you, Abigail. And of course, you guys, we're just taking a look on Tesla. There was an interesting statistic. Colin Rusch of Oppenheimer talking about this. The efficiency of factories. Once you build them, you become more and more efficient. The margins expand. That, of course, coming across on our T-Live blog. Certainly, I know something that you guys will continue to discuss on What Did You Miss? So make sure to stay tuned because I'm done and Bloomberg Markets, the close coverage is done. But What Did You Miss is coming up next. Joe Weisenthal's joining. Maybe all things Tesla. This
and
is
avocados.
Salt.